Hello everyone, I'm Robert Wenzel. Welcome to Robert Wenzel Talks Economics. Today I'm going to be discussing bubbles, investment bubbles. People are always talking about the stock market being in a bubble, the Bitcoin being in a bubble, and I don't think there's really any definition of what a bubble is. And what I'm going to try and do is sort of set some guidelines to the idea of what a bubble is so we know what to expect if a bubble crashes when we define something as a bubble. And this is what I've come up with after studying various bubbles. I would argue, and this is looking at investments that sort of have turned extremely disastrous, where there appears to be a mania. That's one of the keys. It's not. It's sort of like whatever's going to crack this market. The information is already known, and people are ignoring that information and just buying because the price is going up. That's a key. You can have situations where stock crashes or collapses because fundamentals change, something goes on different that's not understood. But a bubble is a situation where there's a mania, where there's prices going up, and there are danger signals flashing, but no one pays attention. So what will happen when a bubble bursts? You can have just a regular bubble, which I define as an investment that goes down for 30 years, goes down by at least 30% and stays down for at least 5 years. So in other words, a peak price is hit, drops by 30%, and then does not climb back up for 5 years. So it's really a dead investment for somebody for a very, very long time. A super bubble I would classify as an investment that drops by 50% or more and takes at least 5 years to recover. Now, I'm also going to introduce two other concepts here: period bubble and permanent bubble. By a period bubble, I mean a bubble where an investment goes down, but it eventually, after 5 years at some point, will recover. And it's just that it's dead wood for 5 years. And I will define a permanent bubble as a situation where the investment never returns. The tulip bubble is an example of that type. The prices of tulips have never reached the peak during the tulip bubble craze. So now what I want to do, first I want to make a point that bubbles generally occur almost always in the boom phase of a business cycle. It's very rare to see something going up during the bear phase of a business cycle. It's mostly a bullish bull market phase. And the other thing I want to make clear is that they really can be different for an individual versus the whole when we're looking at indexes. I'm going to talk about the housing index and how much that dropped, but some people lost a lot more and some people suffered but not as greatly. So it's a case where what we're really doing is attempting to just sort of get a general sense. Okay, so let's take a look at the 2007 financial crisis in the bubble that burst in the housing market. According to the S&P Case-Shiller National Price Index, in February 2007, the price index was peaked at 184.60. It continued to drop for 5 years and bottomed at 136.3. So not only did we have a bubble that didn't peak and come back in 5 years, it was dropping for 5 years. The final drop was roughly 35%. So it fits nicely into our definition here of pain. If someone's losing 35% on investment and it's not coming back for at least 5 years, you're in a lot of pain. As a matter of fact, the index just recovered within recent months to the pre-bubble peak. So now bubble bursting peak. So now we're above that. But that took basically 10 years. So it can be a long time. The next thing I want to talk about is the October 1929 crash. The Dow peaked in 1929 at 362.35. It did not reach its low until June 1932 of 46.85, a drop of 84%. So we're talking about a super bubble here. This thing really came down. But again, with the housing market and the stock market, they were period bubbles because although the periods are very long, they eventually recovered to new highs. The housing market just recovered after 10 years. And with regard to the Dow Industrial, it did not recover and climb above its pre-bursting bubble peak of 362.35 until October 1954, basically 25 years. It took 25 years, so that's really dead money. So that's sort of the parameters that I work with when I look at one of these things and think about, okay, is it a bubble and how bad of a bubble will it be? Now, with regard to Bitcoin, there are 4 factors that I pointed out in a recent video that could really push the price of Bitcoin down. Now, I'm not predicting that it'll be short term. There's a lot of mania. There's a lot of people diving into it. But there are 4 things that could drive it and cause it to then move into a bursting bubble. You could have government interference. You could have a recession. You could have transaction processing problems. And you could have a natural exhaustion of the people buying. Now, all these factors are factors that are known now. So if one of these occurs and the bubble breaks, if there is a bubble, and I believe there is, then people can't argue that this is something that was a surprise or anything like that. These factors are known now. Now, as far as the transaction processing problems, some Bitcoin enthusiasts are aware of it, and they claim that that will be fixed down the road. I'm not entirely of the belief that all the transaction problems will be fixed from all directions. There's a number of different directions that could continue to be a burdensome problem. But there's other factors. The government interference, recession could be a real killer for Bitcoin here. So what do I see? The way I see the mania in Bitcoin and the idea that there is no way you can really value it in terms of an earnings stream, which I discussed in the other video, which I will link to below. You've got a situation where it's very possible at some point it could go up for a very long time, be very, very tempting. Price movements, when they're fast and they're strong, are extremely, extremely tempting to jump in on. So you're going to see more of that. But eventually, I think with Bitcoin, you're going to see a super bubble, which means a drop of 50%. And there's a very, very strong 50%. So that means it's going to be down from its peak for at least 5 years, in my opinion. And I suspect it will be a permanent bubble. And by that, I mean it will never reach the peak, whenever this peak ends. And again, in the other video, it could go to $1 million. It could go anywhere because there's just nothing in any way that you can evaluate and determine what a real value is for it, like a house or a corporation where there's earnings. So I discussed that in the other video. So this is my definition of bubbles and gives me a sense for what kind of bubbles to expect. The housing market always sort of fell into just a regular bubble. But there's a very, very strong chance that Bitcoin could be a super bubble. It can go up for a long time from here. I'm not predicting any timing on this, but there are a number of factors that could really impede the buying momentum. It's the buying momentum that's keeping it going. And then if it's not one of these other factors like the recession or the transaction problems of government interference, then you just sort of have the natural exhaustion of buying. And that's what you have to be aware of. In my EPJ Daily Alert, I talk for ways to invest in it, timing, and when to get into Bitcoin and other e-currencies that are out there. But I also warned my readers that it's an extremely, extremely dangerous thing to do, and you're playing with fire, especially if a recession hits. This time, because the buying is so strong and a lot of it's coming out of Silicon Valley, these guys are going to lose their jobs and they're going to be forced to sell Bitcoin even if they don't want to keep up their lifestyles. And that's going to put tremendous downside pressure on Bitcoin that I don't think it can withstand. So beware on that note. Could be heading for a super bubble. And these are my parameters on how I define bubbles. Thanks for listening.